Good afternoon, everyone, and welcome to HawksBay Self-Storage webinar. Just to let you know before we start, this is being recorded for internal purposes, and the slides will be shared with all the registered participants. That means all of you that are here. The format for the webinar is going to be a very brief introduction, a moderated session about HawksBay Self-Storage with Raheem, Amer, and Imran Ahmed. And of course, it'll then be open to a Q&A session with all of you. So if you have any questions while we're going through this, please do jot them down. A disclaimer, which you can screenshot, and I can read out a little bit as well, is that this webinar and any information in the accompanying presentation is being provided for informational purposes only. It does not purport to be a complete description of all material matters and considerations relating to an opportunity to invest in the fund, HawksBay Self-Storage Fund, LP. This disclaimer is on the screen. Please, again, like I said, read through it, or you are welcome to screenshot it. So let's get started. An introduction to HawksBay Self-Storage. HawksBay Group LLC, or HawksBay, has incubated and is the promoter of HawksBay Self-Storage. It is a boutique investment advisory and management firm focused on generating excess risk-adjusted returns in alternative assets, with a focus on niche, highly fragmented real estate sectors. As a HawksBay portfolio company, the sponsor was founded by self-storage and real estate industry veterans, Raheem, Amer, and Imran Ahmed, to capitalize on a new industry cycle and specific sector attributes. Raheem Amer, who is the co-founder and CEO of HawksBay Self-Storage LLC, oversees all acquisitions, operations, marketing, and asset management of the business. He has 24 years of comprehensive experience within the self-storage sector, including retail operations and management, and he has managed over 4 billion in transactions. Imran Ahmed, who is the co-founder and managing partner, leads the activities of the HawksBay Group, in addition to working closely with Mr. Amer on all aspects of the company. He also directly oversees the business strategy and capital markets function. So let's jump straight in. Amer, my first question is for you. With a lot of real estate sectors suffering in light of overbuilding in the last cycle and the rise in interest rates, why is this a good time to consider investing in self-storage?
Hello, everyone. And Shumaisa, thank you for that question. I appreciate it. I think even with higher interest rates, self-storage continues to outperform because it's a needs-based business. It's a very unique industry because people move, they downsize, they remodel, they go through divorces, they start new businesses, they store inventory, regardless of any market cycle. And at the same time, new development has slowed dramatically due to construction cost, lender pullback, and tighter zoning. This means that existing, well-operated facilities are positioned to grow, and for long-term investors, buying during this cycle creates a better entry point and strong returns.
Okay, thank you for that. So I'm going to jump to you, Imran. What are some of the factors and trends affecting the outlook of this sector?
Sure. Thank you for that question, Shumesa, and welcome everybody, and pleasure to have you on this webinar. So some of the key trends, as it relates to the self-storage sector include things like a slowdown in new supply, which is something that was a direct result of the increase in construction costs and sort of higher interest rates that Raheem respect to which you have sort of the impact of technology, which has resulted in some really much better and improved revenue management tools that people like ourselves and others in the industry are beginning to now implement. There are direct sort of consequences of things like digital leasing, web-based reservation systems that are now being used within the industry as well. And there's also sort of, the continued rise of small business needs, which use self-storage, which are, one of the larger users. And I think that's something that's mentioned on this particular slide in this sort of customer user segmentation category. And then there's, the fact that the industry itself is changing, and changing for the better in terms of more professional management coming in and more disciplined operators, sort of replacing older sort of mom and pop ownership and legacy management in the industry. So I think these are all factors. It's sort of a great inflection point in the industry and a perfect storm, which is going to lead to a new generation of companies and self-storage owners and operators and methods for managing the business going forward.
Okay, you mentioned the perfect storm. So the question then becomes obviously, are the cash flows, are the returns for this recession proof?
Yeah, that's a very good question. And I think there's sort of, four main sort of points to make here. No asset class, regardless of what we real estate people love to say, is recession proof, and particularly when it comes to real estate. But I think what is unique about self-storage and distinguishes it relative to other real estate sectors is that it is very recession resilient. And for the same reasons that I think Raheem initially mentioned in terms of, it is a necessity-based asset class. Life happens, and you need self-storage, and you need to put all your extra stuff that we Americans love to hoard. So that's something that is not going to change. And historical data has shown that during downturns, the demand for self-storage softens a lot less than how other sectors in real estate are impacted. And people will reduce office space, people will give up office space, try to sublease office space, or will move to a cheaper place to live. I mean, typically it does not impact their storage needs because it is typically a smaller sort of percentage of whatever their allocations or monthly expenditures will end up being. And I think that's something that is very important to keep in mind when you consider investing in this sector and sort of the dynamics of the sector. And and people will always continue to need storage during life transitions, and most tenants view storage as an essential service more so than anything else. And then the small unit sizes, as I mentioned, and the low monthly rents make it less sensitive as far as the tenants are concerned to sort of external economic pressure. So, not recession proof, but recession resilient.
Okay, so the takeaway from that, I guess, is recession resilient for all of you who are watching. But then that begets another question, which is, Amer, who uses self-storage? What is the typical customer profile?
Yeah, the customer base for self-storage is very broad. But even though I say that, I'll caveat it with currently, based on the last self-storage demand study in 2024, there's an almanac that comes out every year. It showed that in the course of the last 10 years, self-storage, the amount of people in US that have used self-storage has moved from 9% to 11%. So only 11% of the US population is currently or has used self-storage. So that means there's so much more opportunity for people to use. And I think that's one of the things that makes self-storage a unique product out there. The largest group of people that use self-storage are because they're moving homes. They're people that are dealing with life changes, businesses, contractors, e-commerce sellers, families trying to meet their long-term storage. There was another study that Redfin did about 6 months ago, and they were talking about how over the course of the next 5 years, there's going to be more renters than actual buyers of houses. And mainly because house values have gone up 85% over the course of the last 2 years, and salaries have only gone up 25%. So the gap from where somebody could jump from becoming a renter to a homeowner has increased dramatically. So all that means is there's more people that are going to be needing self-storage because as their families grow, they can't jump into a bigger bigger home. So those are all things that sort of drive self-storage. And our typical customer lives anywhere from 3 to 5 mile from a location. And that's again one of the biggest thing about self-storage is it solves real problems for real people.
Okay, well, thank you for that. I'm going to continue in the same vein. And Imran had touched on something, and I'd like you to sort of go and do maybe a little bit of a deeper dive into this. What are some of this sector's unique features, as in, if you were to compare it historically, how has it performed relative to other types of real estate, which you have kind of touched on, but if you could just go into more detail.
Yeah, self-storage has very strong margins, and I think one of the reasons for that is because of it has low maintenance costs. It has flexible pricing power. We're month-to-month leases. We're not yearly leases, so we can change our leases at any point. Very low tenant turnover cost. And historically, storage outperforms multifamily, industrial, office on returns, mainly because of its less volatility. And the sector has always proven durable through multiple different cycles. In the recent past would be what happened with COVID. It truly accelerated. We had massive increases in occupancy because people were trying to, again, they were working from home. They needed to turn their second bedroom into an office space. And even now, as people are doing work from homes and or at least a hybrid model, there's continued for need for storage and it continues to outperform.
Well, thank you for that, but let's make it a little more personal. We're talking about self-storage. Um, how is it a compelling investment opportunity for me today as compared with the other options that I have available?
I'll give you three reasons that make self-storage very unique. All right. So number one is if you're looking at comparing to multifamily, over the course of the last 5 years, multifamily rents have gone up anywhere from 3 to 4%. In self-storage, the lowest operator is probably around 15%. We average about 25%. So what that means is, say you have a property that has a revenue stream of $100,000 on a monthly basis. We're increasing that revenue from 100,000 to 125,000 to 156,000 to 195,000 in a matter of 3 years. We're literally doubling the revenue. That is very unique to self-storage. That is not, I have not seen a comparable to any other industry out there. So you could literally double your revenue within 3 years. That's a self-storage metric. So that's number one. Number two is turnover cost. When a tenant leaves a multifamily, you have to redo the flooring, you have to upgrade the appliances, you have to repaint. It could cost you anywhere from $4,000 to $8,000 to do that each single time. In self-storage, we walk in with a broom and a dustpan, and in 30 minutes, we have the unit ready for the next customer. It costs me 30 minutes of labor, which is what, $10? So $10 versus $4,000 to $8,000 in turnover cost. So again, when I say low cost, that's what I mean, right? And then the third one is if you have a delinquent tenant. If you have a delinquent tenant in multifamily, you have to go through an eviction process. You're not getting paid back those rents that they owe you. So you have somebody that could potentially cost you 6 to 7 months of rent, and you have to go through lawyer fees, so anywhere from $8,000 to $10,000 in eviction process. In self-storage, if you miss two rents, on the 65th day, I can auction your unit off and I can get 30% of the revenue that you owe me back. And an average in that 2 months, I'm maybe losing $700.
Thank you, Raheem. That's quite a
So
compelling
those
argument.
three things really set self-storage apart.
Okay, so that is quite compelling, I have to say, but I'm going to jump back to Imran then, and I'm going to say, why should I mean, those three reasons are fantastic, but why should I invest with HawksBay as opposed to investing in self-storage through public REITs or any other means? Why HawksBay?
Sure, happy to take that one. I mean, just look, I mean, I think there are some few very simple reasons, right? Right. When you look at the REITs, in particularly the REITs that exist in the self-storage sector, which are mostly large cap relative to the industry itself, which is highly fragmented and, comprised mostly of small ownership, and we'll get more into that. The REITs are large, slow moving, and focused on stable income because that's what the public markets reward them for. So they are not focused on aggressive value creation, which is what drives us here at HawksBay, and that's kind of our sort of mantra. And I think on this particular slide that's on the screen, you kind of have sort of our approach to value creation. But I think what is important about the way we operate and we conduct business and how we will be conducting business for this particular fund is that we operate with speed, precision, and local execution. And what does that actually mean? We focus on underperforming facilities. We are looking to improve the income, net operating income, which is the term we use in the real estate industry, through hands-on management and digital marketing, optimized pricing, and operational improvements. And those are the things that are going to create value for us as a company and for our investors on a go-forward basis. The public REITs cannot execute this type of strategy at a granular level effectively because of their scale, because it's kind of moving a sort of super tanker, right? I mean, it takes a lot to change course, and our returns are directly tied to the performance of the property, and we're not sort of reliant on managing Wall Street's expectations and sort of subject to sort of the vagrancies of the public markets, which is what drives a lot of the actions and the sort of behavior that you see from some of the larger public REITs. And as it relates to some of the other sort of more private operators that are out there, I think there are some unique characteristics and attributes of the self-storage sector, which is the small sort of fragmented nature. And that's one of the reasons we at HawksBay have focused on self-storage as a sort of asset class that we like so much and we're developing a business around, is because of the smaller nature of the assets, where you don't have a lot of competition. You don't have the large institutional players sort of focused on entering this sector and scale in the same way, and the ability to sort of fly below the radar screen, which makes it much more interesting, and we have created a niche for ourselves to operate in.
Thank you for that. Raheem, just to sort of continue with the same thought, self-storage, it's a big market and there's all different kinds of products. Where does HawksBay play and why?
Good question. I'd say we focus on value add facilities in growing suburban and secondary markets. These properties often have outdated operations, minimal marketing, and a very weak revenue management system because they're owned by legacy owners, mom and pop, who have never really used modern tools. I've gone into properties where we've taken over and they're still doing pen and paper and they're writing down every tenant and when they owe and who they owe and all of that stuff. And they don't even use Excel in some cases. So this creates a clear path to NOI growth without needing any major construction for us, right? So
Okay.
our approach avoids the high price trophy markets,
Mhm.
primary markets, and we instead focus and target where our operational skill can produce an immediate lift.
Okay, but
And
sorry, go ahead.
yeah, no, and currently we have 60 properties all over the country, and half of my properties are unmanned, and there's nobody at those properties, and we have sort of used technology to run those, and we're doing that currently across the country right now.
So let's get into the specifics of the technology that you are using to improve
Okay.
the performance and deliverables that would result in you generating higher alpha. Like what would they?
Yeah, as I said, technology is the biggest key that drives
Okay.
self-storage forward. And you gotta let's take a step back and let's really understand what the self-storage market currently is, right?
Hmm.
So there's 60,000 self-storage properties across the country. 17% of them are owned by REITs. That's Extra Space, Public Storage, CubeSmart, U-Haul, and some of the large operators make up another 7 to 8%. So in total, 25% of those 60,000 are owned and operated by a major operator that really understands technology.
Okay.
What that means is 75% of the self-storage market are just mom and pop folks that don't understand marketing, that don't understand what revenue management is. Today is like, today I feel that the wind's coming from the right. I think this customer should get a rate increase, right? So they really don't. It's more of gut and what feels right. I've seen websites where or acquisitions where we've gone to an owner and they're like, yeah, I give a rate increase once every 3 years. Why? Well, because I'm 100% occupied. Well, why are you 100% occupied, right? That doesn't make sense. Why would you be happy that you're 100% occupied? We try to push rates and we want to be in the 90%. If I have a property that has 92% occupancy, I'm scratching my head going, what is my revenue management team doing? Because that tells me that we're not driving rates hard enough, that some of those people leave and new people come in with those new numbers. So that's, again, that's a strategy that mom and pops really don't understand. So we use, we come in, we update a website, we have new strong SEO and digital lead generation system that really drive leads to the property. And because we drive leads to the property, we have dynamic pricing and revenue management to really accelerate the rates that a particular property is charging, which of course helps increase that revenue that I was talking about and that 25% increase in revenue, right? So all of this is sort of tied together. And then ECRI optimization, and ECRI stands for existing customer rate increases. We are a month-to-month leasing company, right? So it's in self-storage. Today you move in at $25, and tomorrow, if I see that that unit type is completely occupied, I move you to $35, in rent. And then if I continue to see demand and there's not enough availability of units, I can move that $35 to $50 in the 6th month, and so on and so forth, right? And that's the unique nature of self-storage. And again, let me step back and sort of talk about that. When somebody moves their stuff into a unit, I don't know how many of you guys have used self-storage. Love for you guys to put some in the chat. If you have used self-storage, put it in the chat. I'd like to see how many people that are attending right now have actually used self-storage. But you have to understand the nature of the customer that you have, right? So they buy a 10 by 10 unit, size of a small bedroom. They take all of their stuff, they load a truck, they take it over there and they put it in. I'm charging you $60 for that unit. Great. You've loaded that unit and you're all set to go and you move out, right? So in the 3rd month, I move that and I give you a 20% increase, and I go from $60 to $72, right? You're thinking for $12 now, I need to go rent another truck. I need to hire 2 people. I need to pay for the rental truck. I need to pay those people lunch. I need to destroy my weekend. I need to take the truck and those people to go to the storage facility, take everything out, put it on the truck, and I still need to figure out what I'm going to do with this item, right? So now I need to go take it to another unit at another property that maybe is charging $50. I put that in there.
No, I get that. And then to add on, you don't know how that other unit will be,
Yes, exactly,
whether
right?
they will be as good as your unit. And
Yes.
then if they increase the rent, then it's just a back and forth between you and them.
Absolutely.
Not worth it for the
And what
extra.
happens with the customer is the customer goes, for $12, this is all the things I need to do. You know what? I'll hold on for a couple more months. I'll figure out a better game plan. And that continues to happen month after month after month. So remember how I was telling you about that 2024 self-storage demand study? It says that an average customer, when they move in, they tell us they're going to store for 2.6 months. But an average customer sticks around for 11.2 months. So that's where we make our money, is because when people move in for $12, it's a 20% increase. But for that $12, they're going, you know what? I don't want to really destroy my weekend to do all of these things, I'll just absorb it and I'll move on. And 73% of our customers are on auto pay, so they don't even realize they're paying us $12 more till 2, 3 months later. And then by that time they realize, you know what, I've already absorbed this, so I'll just continue. It's the Netflix method, right? I don't know how many of you guys have Netflix, but if you notice they keep changing your pricing, by the time you realize you've already been paying for it for 2, 3 months. And that's exactly what we do.
Great, Raheem. We have a lot of other questions coming in, so I'm going to ask you all the questions that I have regarding
Sure.
this, and then we'll jump into all the questions that
No problem.
our participants have. So this one is for both you and Imran, which is if you guys could describe the HawksBay self-storage approach to business. I mean, I think Raheem, you've done a pretty good job at it, but like, let's say, Imran, is there anything else you would like to add to that? What are the unique things about it?
Yeah,
I'll go first.
no,
I'll go first.
go ahead. Yeah.
Yeah, I would say our model focuses on disciplined operations and data-driven decisions and local marketing understanding. So we avoid shortcuts, we don't rely on hype, and we stay focused on the fundamentals that drive revenue every single day. So consistency, accountability, and operational excellence are the foundation of what we do every day.
Imran?
Yeah, and just to add to what Raheem just said, I mean, obviously operations are key to this business. I mean, this is an operating business, and this is one of the things that I think people just don't realize when they invest in self-storage. I mean, I've had a lot of friends, who at various points of time have invested in sort of, different self-storage deals, and then at the end of the day have realized that, this is much more akin to owning a hotel than it is to owning sort of a long-term net lease property where you're clipping a coupon. Where you really have to focus on the operations and making sure that you get it right. But as a sort of more sort of macro, from a macro perspective, the approach that we're taking at HawksBay in terms of, one of the key additional components that's on this slide of value creation is the sort of the strategy of aggregation and creating a portfolio of properties. And as I hinted on earlier, each one of these individual properties, particularly sort of in the secondary sort of growth markets that we're focused on, suburban locations, they're not high dollar volume properties, like they're not that expensive. So, effectively there is an opportunity to create a portfolio of these type of properties that has a certain scale and creating a package and creating a assemblage of these properties that can trade at a premium once you have optimized their operations. And so that is an approach that we're taking, and there's a real arbitrage opportunity that exists in the marketplace, where a lot of the institutional investors that are now looking and have raised a tremendous amount of capital, particularly some of the sort of asset managers who raise money from pension funds, are looking to deploy into the space because of all the characteristics and attributes in terms of the predictability and the stability of the cash flows. But they are limited in terms of the scale and size at which they can operate, and they need large portfolios and large scale deals to deploy the capital into. And that's one of the things that we at HawksBay have a keen eye towards, because not only are we looking to make attractive acquisitions and then improve operations to create value, but at the end of the day, we are looking to deliver returns to our investors. And the way we do that is thinking, about how we're going to exit the portfolios that we assemble. So that's part of our value creation strategy that we keep very much in mind. As more the strategy and capital markets guy, I have to think about that while Raheem focuses on the operation side of the business.
Got it. Thank you for that. So then let's just get to it. How would I invest in self-storage through HawksBay? What does the fund offering look like? Imran?
Yeah, so this slide basically lays out kind of what we are looking at from a HawksBay fund offering perspective. Obviously our approach is all built on acquiring a diversified portfolio of clustered self-storage properties, across secondary markets. We are looking to position and stabilize these properties. We're looking to raise for this particular fund about 10 million in equity, to purchase properties that we think will offer very attractive risk-adjusted returns as per our investment program, which is really focused on operational improvements and through, really relying heavily on technology. We're focused on sort of a total return strategy. We will be looking to deliver sort of quarterly distributions as the cash flow becomes available and as we sort of reposition and stabilize these properties. And the intent, the investment vehicle itself is a 5 to 7 year vehicle, and we will look to sort of liquidate within that time frame. The opportunities are primarily value added, but we may selectively look at some development deals, though that's not a core focus. And we may acquire some stabilized properties as part of many smaller portfolio acquisitions to the extent we can. We think they'll be accretive to the overall strategy. I think, just given everything that's happened and sort of some of the sort of excesses over the last cycle, there are some very attractive opportunities that are coming to market now as we're at that inflection point itself when it comes to the industry and the sector. When it comes to the specifics of how you can invest, I think what we're offering is 3 classes of shares in the fund itself, with the starting at a $50,000 minimum. There is a preferred return structure where the investors get all their money back and a 8% preferred return before the manager actually starts participating in any kind of profit sharing or anything like that. For those of you who are familiar with that type of fund investment structure, we're looking to deliver sort of a 15% net return to the investors, net of all fees and expenses, which are all laid out on this sheet as well. So it's a fairly sort of where typical commingled fund investment structure, finite life, 5 to 7 years, with different classes of shares, with different economic profiles, depending on the size of the investment.
Thank you for that. So continuing with that, how would you contextualize the self-storage this investment opportunity that you've described in detail, relative to other real estate property types and the performance of different available investment options?
Sure. Yeah. So, I mean, look, I think Raheem briefly touched on that, and now you can sort of see this sort of graphically, particularly if you look at sort of how the different real estate sectors have at least performed in the public markets, and and their return over the last sort of 30 plus years, and particularly in the context, what is helpful in this chart, and when you look at sort of the volatility versus return, you can clearly see that self-storage has outperformed even the sort of more recent darling industrial, which everybody seems to be talking about. And apartments, albeit consistent, have not performed as well as people would think. And not surprisingly, office has taken a beating, of late, just given with people work from home and other things that are happening. And then hospitality, which seems to be the darling of certain investors, is probably suffers from a lot of volatility and most susceptible to sort of economic downturn. So not surprisingly, is kind of towards the bottom, and probably the most volatile in terms of performance as well. But what is also interesting when you look at the bar graph on the right is the projected returns for this particular vehicle, which is sort of 15 plus net. If you compare that to how even what the stock market has done, the S&P or the Dow Jones Industrial, or any of the other asset classes, whether they're real estate, non-real estate, or any of the other investment options that people may be considering, based on the historical performance and what we think the sector is going to perform sort of on a go-forward basis over the next 5 years, clearly you can see, where sort of self-storage sits on a relative basis, and it provides a much better risk-adjusted return.
Thank Thank you. Two last questions, and then I can see that the audience members have put in a lot of questions, so we'll immediately jump to them. So the first one is for both of you. Tell us about your team, your credentials. Why are you the right people that we should be investing with? Raheem, would you like to take that one, and then maybe Imran could follow up?
Yeah, I would say again, been in the industry over a decade now. Started out with extra space storage. I really didn't know anything about self-storage when I got into it. It was a fluke that I actually got into self-storage. And I quickly realized that this is a hidden gem that not a lot of our community is well versed in. And it's a unique industry. After building out operations and revenue management for Extra Space, decided that I was going to go out and do this on my own. So the first company that I went to was with Devon Self Storage, where we only did third-party managed properties. We didn't own anything. We just ran properties for everybody else because we knew how to run properties, and did that for about 3 years before I sold that and then moved to the another company that was an investor that had tons of money, and they needed to deploy almost $2 billion over the course of the next 3 years. And they were coming out of Canada. They had zero presence in the US, and they needed somebody to run the company for and deploy that $2 billion over the course of the next 3 years. So partnered up with them, did that for about 2 years, and in those 2 years, we grew the portfolio from zero properties to almost 150 plus properties. So again, tells you that over and over again that there's huge, huge demand, right? And then after that, I'm at my third venture now, which is My Place Self Storage. And the reason for that is at Minimal, I was only acquiring properties, and I wanted to develop. I wanted to do third party management. So at My Place, that's the venture that we have sort of launched. And I'm looking for my next one to be more of how do I also have I've had a lot of friends and family and people that I know that have said, "Hey, I want to get into self-storage." And I've sort of stayed away from the syndication part of it, and then partnered up with them and said, "Hey, why can't we do this as part of the My Place brand and bring a syndication fund over, and we can run that as part of the company?" So that's where we've sort of partnered up, and now we can give this opportunity that I've been privy to for the course of the last decade to each and every one that wants and is interested, but doesn't have millions and millions of dollars to invest in self-storage.
Okay, same question, Imran, and then our final question.
Yeah, look, I mean, like Raheem, I've been involved with the self-storage industry for a long time, first initially as a banker, starting 25 years ago, covering some of the largest names in the industry today. And when we started HawksBay, this was a sector that clearly fit very nicely into the profile of what we focus on, which is fragmented sectors where we can create sort of incremental value and deliver excess returns, and really focus on, generating true alpha, which, in terms of, through asset repositioning and operational enhancements and sort of intelligent structuring. And that's kind of what we focus on across the board at HawksBay. And this really, as an operating business, fits very well, and the ability to sort of partner with Raheem and kind of create a de novo platform that takes the sort of best from an operational perspective, best from a capital markets perspective, and best from sort of a sort of hands-on improvement of the asset perspective, and then the opportunity is very unique in this sector, and particularly since we are at that inflection point. So I think that it has all the components, and the timing feels right in terms of where we are in the real estate cycle at the beginning of a new cycle to really tackle this opportunity.
Thank you. And my last question happens to be in sync with the last question that an audience member has actually put on the chat. So thank you, Shahab, for that question.
Actually, Shemesa, just one quick thing. I know we forgot to mention that. If you want to be part of this conversation, there's a QR code at the bottom of each one of the slides. Please scan that, and you can be part of this. And that's where we're actually going to be sharing the slides also. So each one of the
Each one of the slides has a
yeah,
QR code at the bottom left-hand side corner of your screen. Just go ahead and scan that, and then you will be registered, and you can get a copy of these slides
perfect.
and all the information that you need. So thank you, Shahab, for the question. And I'm going to, I guess, I have the same question, which is this investment Sharia opportunity Sharia compliant? And if you are saying it is, have the recognized scholars approved the structure? Imran, this question's for you.
Yeah, no, absolutely. So we are using a sort of a JARA structure, which is a master lease structure that is tried and trusted, has been blessed by a number of Sharia scholars and Sharia boards, and primarily, I think City Islamic out of Bahrain has blessed this structure, as has Kuwait Finance House, which is the largest Sharia compliant financial institution in based out of Kuwait, with recognized scholars, and that information is in the deck, and that and you can see who they are and what those Sharia boards are comprised of. But it's something that is well established, well acknowledged, and everything that we will be doing will be in compliance with that structure.
Great, thank you. Now let's move to a couple of other questions that the audience members have. For the benefit of this group, Amer, can you provide greater insight into the track record and the investment criteria of the case studies? Did they play out as expected?
Yeah, there are case studies. Can you flip through those real quick, Osman? And
Just
so
very
there.
quickly so that the audience can,
Yeah.
yeah.
Yeah. If you want to go to the slides real quick. So there's case study one. So that's slide 19. So we have case study one, case study two. I think we have two case studies, maybe three in there. But we built out, these are acquisitions that we've had over the course of the last 4 or 5 years, and sort of talks about the returns we've gotten at each one. So case study one, the IRR averaged around 25%. Can you go to case study two? This one is about 16 and a half, but we had not, we were still holding it. So when I departed this portfolio, we were still holding it as a company and we hadn't sold it. So 16 and a half was based on the last NOI that we had, but I'm sure this was going to be close to a 25% also. And the case study three, same thing. We were still holding it when I left, and based on the NOI, we would have averaged a 19% if we had sold then. And over the course of the next, and that was just I think a year after we had acquired it. So the IRR continues to drive, and the number is based on a 5-year return. And this we hadn't even scratched the surface of the 5-year on this.
Okay, thank you for that.
And you guys can dive, as I said, when we share the slides, you're welcome to dive through it in detail and reach out and ask questions.
Absolutely. And I think that the QR code is working now. I was a little concerned about that. Okay, so
It is working, but
yeah,
if somebody has in their phone settings, my wife had this experience the other day. You have to make sure that the QR setting is turned on. If not, it does. If you just open your camera, it doesn't work.
thank you for that, Raheem. Um,
And I'll volunteer respond for tech support if anybody.
okay, so the question from Feroz, can you please share the company website and well, the company website and all the information is available on the QR codes, but how many storage units in the Dallas-Fort Worth area?
So, as part of the My Place Self Storage brand, we have 60 properties across the country. And the My Place website would be myplaceselfstorage.com. And in Texas, we have 5 properties, uh, two in Dallas. We just recently, actually 3 weeks ago, we bought our second property in Dallas. So we have one in right on Mockingbird, next to Dallas Airport, Love Field Airport, and the other one is in Denton that we just bought 2 months ago. and that one is right next to the Denton, the UNT University.
Okay, Sayed Ali Khan is asking, do you sell insurance with the units or require the person who is
We
renting?
do. It's a,
Oh,
it's a
you
it's a huge ancillary lift for the property. Yes.
And then what's the minimum insurance?
$14. So we have $14, $19, $27. Average customer that says that they're storing says that their average value that they're storing is about $3,500. So the $2,000 property is 14, the 3,000 coverage is 19, and the $5,000 coverage is 27.
Okay. Shahzeb has a good question. What alignment do you have with investor skin in the game? For example, GP co-investment, preferred return, free signature.
Imran, I'll let you take that.
Yeah, no, absolutely. So, there will be GP co-investment. We are still determining what that amount will be, but there will be definite alignment with investors from that perspective. So it'll be fairly typical, it's 5 to 10%.
Okay, thank you. And then Aman Khan has a question. What's the cost of building one storage facility, like 100 units, temporary control, without land cost?
All right, so let's work the math. So 100 units, say they're about 125 square feet each average. You're looking at about 12,000, 13,000 square feet um, property. To build something like that, it'll cost you about $150 per square foot to build. So you're looking at about 1.9 million. And when we're acquiring properties, we're acquiring them sub 100. Um, Anywhere from $80 to maybe $120. So we're getting a built revenue, built out property that is already generating revenue that we can use that as part of our debt and our revenue structure. So trying to build something, and of course it has a huge upside, right? But trying to build something and then rent it up and then get the revenue, that's a bigger investment. And we found that it's easier, cheaper, faster to acquire those same 13,000 square foot properties at half the cost, and you already have the revenue that's coming in. You can see what everybody else is charging. You can see who else is developing. So you know how you're going to build out that revenue structure and that return structure over the next 3, 5 years.
Great, thank you.
Yeah, no, let me add one thing there, because one of the biggest opportunities that we have right now, and one of the biggest mistakes that people make when they get into self-storage, particularly when it comes to development, is they underestimate how long it takes to lease up and stabilize a self-storage facility. This is not multifamily, and this is not like you build it and they will come. On average, it takes 3+ years to stabilize and fill up a self-storage facility. And some of the biggest opportunities that we're seeing right now in the marketplace is people who made the mistake. Some hotel developer in Arkansas, Oklahoma, wherever, biggest spot in the country, basically had a site where they couldn't make a hotel work or couldn't make a multifamily property work, and decided to put self-storage on there, and took recourse loans, and basically completely underestimated how long it would take to not only build but also lease up and stabilize the property, and now has that recourse loan coming due, and now is forced to sell to get off that recourse on that financing. Those are the type of opportunities that we are particularly focused on, and we can be opportunistic about, and particularly since the rise in interest rates, and those people are finding themselves getting into all kinds of trouble as the interest payments are going up with the floating rate debt that they took on. So, it is kind of a perfect time to be buying, where you can buy existing facilities that are already leased up and cash flowing below the cost to develop and build. Now, albeit you're building a different generation facility, but it's also at a very different price point. So, and that's why we're really focused on sort of the middle market, and the market where we see sort of, we like to call it the fat middle, right? That's where all the opportunity is. Where majority of the people don't want to kind of spend, $300 a month for a climate control, whatever fancy facility. I mean, to store this sort of farm equipment or whatever garage stuff sits in their garage today, they're more than happy to pay $100 a month or $120 a month for. And that's kind of where we're spending our time, and that's where we're focusing, and that's where we're optimizing operations to increase the margins and create value for our investors, where we can get in below cost, in replacement cost.
Okay, so we have a ton of other questions coming in. Majid has asked, what is the length of investment? What is short, long term? What does that look like? And is the profit does the profit distribution start in the first year? What is the I think you did mention about the exit strategy, but if you could just talk a little more to that.
Yeah, no, absolutely. So happy to. So look, I mean, the vehicle itself, we're saying 5 to 7 years. We expect to exit sort of somewhere between year 4 and 5. Sort of liquidate the portfolio, because the whole strategy is to create a large enough portfolio that's going to be interesting from an acquisition perspective for some of the institutional pools of capital that have been assembled to go into self-storage. And what that means, building up a portfolio of, $200-300 million over some period of time. So whereas this vehicle itself is a $10 million fund, but we plan to raise subsequent vehicles which will continue to aggregate these type of facilities. When it comes to creating value within the facilities themselves, from an operational perspective, that is sort of a 2 to 3 year process in order to get to that stabilized sort of revenue number that we're looking to get to. So that is kind of our value creation cycle, and hence sort of the 4 to 5 year sort of exit horizon, because at that point we sort of have optimized operations, have created all the value that we want to create, and have hopefully aggregated a sufficient scaled portfolio that's going to be interesting from an institutional exit perspective. Now, as it relates to the distributions themselves, we expect to be cash flowing sort of out of the gate, not hugely cash flowing, but we would like to build up to that sort of steady dividend stream, which is, high single digits over the next 2 to 3 years. But we will start making distributions as soon as cash flow is available, which will probably be within the first year, even as soon as this second quarter of your investment. But that will depend on this individual properties, and some will be sooner than others. But as the cash flow comes in, we will look to distribute it.
Great, thank you. And Mushtaq, the recording is available. If you have missed the first 40 minutes, just scan the QR code and sign up, and you can access the website, and we will have the recording sent to you. Another question from Mashkur. Can someone participate with less than $50,000?
That's going to be on a case-by-case basis, and we're happy to have that conversation.
Okay, and then Shahab has another question related to Sharia compliance. And this is, I guess, for you, Imran. Have the company's financial ratios, debt, interest, income, cash, been reviewed against Sharia compliance criteria? I know you did speak to.
Yeah, with the Jara structure, I know that's not going to be an issue, because the way the master lease structure works, we're going to keep any kind of financing away from the fund itself. So from that perspective, this is in terms of the ratio itself, we will be definitely within what is considered norms, but the structure itself allows us to basically bypass a lot of those considerations.
Great, thank you. I think if there are any other questions, we do have some time left, so you're welcome to put them on the chat, and I'm happy. Aisha just put a question. What is the return expected for, thank you, Aisha. What is the return expected for 5-year exit that is being recommended?
Yeah, so the return over a 5 year hold is going to be a sort of a 15% IRR. So think of it as an annualized return of 15% net to the investor themselves. That's what's anticipated.
Okay,
so 15% per annum, not 15% total.
Right. Okay.
So that'll probably be, over a 5 year horizon, 1.5 times or 1.75 times multiple effective.
Okay, that's good to know. All right, we still have questions coming, which is great. Aman, wait. Apology, this is Tariq. You don't need to apologize, Tariq. Every question is a valid question. I am not clear on the payout frequency and IRR. Could we clarify that for him, please, Imran or Raheem?
Well, we expect to pay out.
Payout frequency and IRR.
Yeah, so we would expect the dividends to be paid out on a quarterly basis, and the IRR is obviously a cumulative return. So, a significant portion of that will come at exit.
Yeah.
So, the quarterly dividend will be sort of probably in the sort of mid to high single digits range once we hit that stabilization point, and then the balance of the return of the 15% on an annualized basis we're talking about. So, 40 to 50% will come from that sort of back end exit and from the capital appreciation.
Okay, and then Shazib has another question. What percentage of your debt is fixed versus floating?
So good question. Initially, it'll be floating rate for the most part, because that's what is available for transitional assets. As soon as we get to a point where the assets start stabilizing, we will look to fix it to the extent it makes sense and what's available in the capital markets. But by the same token, we will be hedging. So, either through swaps or caps, which is what is going to be required by the lenders. So effectively, we will be fixed at some rate, and that'll depend on what the cap and swap requirements are.
Great, thank you. And then Aisha has a follow-up question, but first I'm going to go to Mudassir's question. Yes. What are the security protocols you have in place against burglaries and theft? Is this a big issue? How do you deal with this threat? What could be the potential adverse impact, if any?
It's an issue. It's not a big issue. And we have, as part of our tech stack, one of the things we launch at all the properties is a AI protected camera system. It's called Rhombus camera. And what that does is as soon as there's activity at a property, we not only notify, again, between 10 p.m. and 6 a.m. is complete shut off. There shouldn't be any activities at the property at that time. So that camera system, as soon as senses that there's some human feature, there's humans at a property, it takes a picture, sends it to the police, sends it to the management of the property and the regional in charge of the property, trying to offset it. The police are also have access to jump on an audio system and talk, and and there's been many cases where they've reached over the audio system and said, "Hey, you in the red hoodie, this is this is shutdown zone, and you are on a property, and if you don't get off the property immediately, we'll be sending a squad car." So we have built relationships with a lot of these security agencies and the police, and we're able to minimize any of those hits that were normal in the self-storage industry prior to the tech stack.
Yeah, let's take one more question at least before we wrap up. It's from Zaki. What is the exit strategy? What is the minimum investment hold period before an investor can exit? What would be the estimated monthly return on, let's say, $100,000 investment? What is the overall return structure designed for investors?
That's a lot. That's a
That's a
lot of
lot of
data.
questions. That's why I thought, let's take one more question and then we jumped in
That's
more.
about 8 questions in
No,
one.
but it's good
But
to have an
no,
audience that is
it's great.
engaged
I'm
and
glad
that
glad
knows
you're
what we're doing.
asking all these questions. So I'll have to be, in case I miss anything, let me know. So let's start off with the distribution, the monthly return. So we are not making monthly distributions. We'll be making quarterly distributions, right? And we expect to, like I said, somewhere between mid to high single digits annualized sort of distribution. So let's just pick a number. Let's just say we expect to stabilize at around 8% cash on cash yield, let's just say. So if it's $100,000, that's $8,000 a year, and every quarter you should expect about $2,000, right? I mean, that's kind of the rough math. Now, what we're saying, it's a 15% net IRR. So effectively, on an annualized basis, you should be getting $15,000. So the balance of the $7,000 you'll get on a look back basis when we exit the investment at, let's just say in year 5, for argument's sake. So that would be the way to think about it. Now it'll be compounded because it's a IRR, it's a look back IRR concept. So it's not going to be $7,000. So it's, you're not just getting made whole on a simple basis. So it'll be higher than $7,000 in terms of the aggregate payout on an annualized basis. So, 7 times 5, so 35,000 lump sum will probably be closer to 40+ thousand to make up for that time value of money.
Just to clarify, you would get the 100, if in that scenario, if it was $100,000 investment, you would get the $100,000 first, and then on top of that, you would also get another 35,000 to get you up to that 15% IRR,
Correct.
20% IRR, 25% IRR, whatever that number is, that's what gets you caught up.
Exactly. So it's so let's just kind of say you're getting 8,000 roughly per annum from a cash flow perspective. Initially, the first couple of years it may be lower because you're ramping up and stabilizing, improving the operations of the property. The latter years, so 3 years of full 8,000, first couple of years maybe you get 8,000. So if I'm doing the math correctly, that's you're talking about $32,000 in sort of ongoing cash flow distributions over that 5 years, plus the 35,000 sort of compounded. So let's just say that's 32 plus 40. So that's how we were getting to that 1.7 times multiple. So that's like $72,000 of distributions on top of the 100,000 you put in. So if you put in 100,000 day one, at the end of year 5, hopefully you receive $172,000, and that gets you to your 15% IRR. So hopefully that answers one part of your question, or 3 parts of your 8-part question. What did I miss, Sumesa?
I don't know, but I do know that the quick mental math was very helpful on your
Yeah.
part. And but no, I think you did answer all of the questions. They'd ask for minimum investment hold period before an investor can exit. They'd ask for
Yeah, so individual investors cannot
450.
exit their investment. It's going to be a sort of liquidation of the investment fund itself, and everybody will get liquidated at that point in time. So it's not like you can. There's no redemption option. You can't. Unfortunately, we're not in a position to say, "Hey, I want my money back today." 2 years into the investment, it is an illiquid investment. You're sort of in there for the duration of the life of the fund.
There was one question that we sort of skipped over from Sherbana Dosa, and they were asking if we're also involved in construction of new facilities. So at my place, we are, but in this fund, we won't be bringing in any construction facilities because, as Imran had said earlier, it would take us a year just to get the entitlements right. Then it would take us another year to construct it, and then it would take us another 3 years to rent it up. And so that you're looking at almost 5 years before we start getting decent revenue stream to start paying you back. So if we go after a construction facility, the return would be longer and farther. The returns would be great, but you're looking at almost a 7 to 8 year return cycle. So unless somebody's interested in going into a fund like that, that's not something that we're doing in this first fund tranche. Imran, anything else you want to add on that?
Yeah, and then so look, I mean, at some point that may become more compelling as an opportunity. Right now, just the market as it sits today, we think they're great value add buying opportunities. There's a lot of consolidation. I think, there was a slide that we went through in terms of how fragmented the sector, the real estate, the self-storage space is. And I think that's kind of where we see sort of a lot of the low-hanging fruit. I mean, to that point, 2/3 of the sort of, 50, I'm always, even being in the business and you're looking at stats all day long, I'm always confused by the number of self-storage facilities because the estimates range from anywhere from 50,000 to 60,000. But whatever the right number is between that 50 and 60,000 in this country, 2/3 of them are owned by mom and pop owners, right? And non-institutional, with people who own less than 5 facilities. I mean, there is no other sector in real estate that has that kind of fragmented ownership, right? So, and a lot of them were people who went into this business 30, 40, 50 years ago, and their second and third generation that right now have no interest in continuing in that business. And so there are succession issues, there are estate planning issues, and for that reason, a lot of people are looking to liquidate or sell their assets because now, the children and grandchildren have moved on and are doing better and more interesting things and have no interest in managing a self-storage facility in Hot Springs, Arkansas, for example. So, to use Raheem's favorite market as an example, where he has been incredibly successful buying and assembling a cluster of properties from exactly that type of ownership. So I think that those are the kind of things that we are looking to effectively take advantage of, where we can get in a very attractive basis. And that's why, construction and development is not particularly attractive today. Now that may change over time, if that becomes a more attractive opportunity set, but then we would be looking to raise a 10-year vehicle that could accommodate the life cycle of building and stabilizing.
So we do have a lot of questions coming in, but I think we are out of time. And or would you guys be open to continuing? I think we
Do we
will.
have more questions coming?
Yes, we do.
I mean, we can go for another 5-10 minutes.
Okay. All right, fine.
Since we're here.
Since you're here. Otherwise, if you guys have scanned the QR code, we will send you the presentation and you can obviously send us your questions. And thank you, Shazim. I'm glad you enjoyed the presentation and the.
I think one last, if we could just address, some people have asked how they can invest through their self-directed IRA.
Yes,
Or-
that's a good one.
Usman, you've had some recent experience dealing with that issue, so you wanted to talk.
Sure. So, yeah, typically the self-directed IRAs have a fund advisor, and you just have to provide our information. So once we have subscription agreements available and we're raising capital for the fund, so you give them the deck, they can look us up. If they have any other questions, they can reach out to us. But essentially, they manage sending the funds, so that it has to go directly from that account, and the return goes back into that account as well.
Thanks, Usman. Then there's
course.
another question from Mudassir, and he says, you highlighted that you are open to GP stake discussions. Is there a minimum ticket you have in mind for a GP stake? What are you valuing GP at? Any information as in would be helpful.
Yeah, I mean, that's a separate discussion, and we can have that, Mudassir. I mean, if you want to just reach out to me directly, I can kind of engage in that conversation, because that also has to do with the scaling of the platform. I mean, not less relevant for this $10 million vehicle, but in terms of broader discussion of where the platform is going, so we can engage in that conversation.
And then let's just take one more for Khan's asking, how do I actually invest into the fund? I'm assuming it's not the typical, they see you can trust me with your money approach. Is this through something like Fidelity? You have a great sense of humor, Furkan.
Oh, come on. I was hoping for the trust me and just, I'll give you my phone number and you can sell me the cash and that's it. No, in all seriousness, yes, there will be a subscription agreement, through our legal counsel and everything. And then, you would have to sign up for the subscription agreement, wire money into the fund's account. It will be all handled in the name of the fund. So, you will not be sending us money personally, and we will not be disappearing with it.
And on that note, thank you very much, Raheem and Imran and Usman, for taking out the time for this fantastic webinar, and to all the participants who came in and had these fantastic questions. I, quite frankly, had a lovely Sunday afternoon. I don't know about the rest of you. So it was a pleasure.
Shumaita, thank you so much for hosting. I appreciate it.
No, it was lovely. And I look forward to doing this again next time. Take care. Bye-bye.
Bye-bye.